Welcome to another edition of the Headway Wealth webinars that we're hosting. Again, we have our very special friend, Bryan from Humphrey and Co. Nice to see you again, Mike.
Thanks, Hamzah. Hope you're well.
Very good, very good. For the second time now, we've got another conversation from the first Lady Chancellor, I believe, Rachel Reeves, who I'm not sure about you, but I'm not sure that the UK people have been overly enamored, especially not business owners like myself, have been overly enamored by what she's introduced.
No, I think she's had a tough time. I don't think she's the height of popularity in the UK at this moment.
No, well, let's see what these changes bring us for the next 12 months as we delve into another tax year. First thing, I thought we'd just head straight into it, and some of the changes, something I hear a lot about at the minute for many people about taxation are stealth taxes, and the government has basically frozen the thresholds, which I believe are for the basic rate taxpayers.
Yes, but also for the higher rate taxpayers, additional rate taxpayers, and that stealth tax, which we can touch on at 100 grand, which can be very, very expensive. A lot of the UK population will not care too much about those that are earning 100 grand plus, because they're going to argue that they're very, very high earners. But tax thresholds have been frozen. They were frozen by the Tories, I think, in the last couple of years that they were in power. Labour, in their autumn statement, confirmed they weren't going to increase them, so they remained frozen. And what that does, because of inflation, right? So the UK is running at something like 2.8% inflation at this moment in time. So the cost of buying things is going up. Naturally, especially in the private sector, the government sector, the NHS and various other public bodies are ruled slightly differently, but certainly in the private sector, it would be expected to get an annual pay rise from your employer if you are an employee, normally in line with inflation. So your disposable money is the same now as what it was a year ago. Okay, if inflation's 3% and your pay rise is 3%, then the theory is you've got the same amount of money to go and spend and live your life. Now, of course, if tax bands aren't increasing by 3%, then more of your money is going to be taxed at the basic rate or the higher rate or the additional rate, depending on how much money you are earning. So by freezing tax thresholds, the government's coffers will be more full because they collect more cash from the worker. And Labour are very, very vocal about not increasing wages for workers, and they didn't increase wages for workers, but effectively they have by not increasing the thresholds. And of course, the other thing which we may touch on later, being the employer national insurance increases, because employers will naturally feed that additional cost onto their employees in some way, shape or form.
Okay, well, if we stay on employees for now, I mean, more and more of our clients are earning more money, and rightly so. Inflation's going up while people perform. As an employer, I want to encourage people to perform better, to produce more, and reward them. And 95% of the time, people are rewarded in financially, basically. Yeah. Nobody, if I asked people that work for our business, would see a reward other than, here you go, there's more money. You're doing a great job. So if I just touch on that, one of the stealth taxes for employees is once they earn as an employee over £100,000, let's just touch on the things that they miss out on and what they lose.
Yeah, fine. So the first one is your personal allowance. Okay, and this is another stealth tax, because if you looked at your tax data card, which confirms the main rates of tax, you will see three main rates of income tax. Income tax is what an employee will pay, and they will pay basic rate of tax, 20%, they will pay the higher rate of tax 40%, and they will pay the additional rate of tax at 45%, and they kick in at different thresholds depending on how much you're earning. But what actually happens is between 100k and 125k is you lose your right to your personal allowance. So most people can earn 12.5 grand tax free, 12.5 grand at 0%, unless you earn over 100 grand. And to put it into layman's terms, effectively you're taxed at a 60% tax rate, 62% tax rate, including national insurance, in between 100k and 125k, because you're paying your higher rate tax of 40%, and you're also losing your personal allowance, which makes an effective rate of 60%. So very, very expensive. So that's number one. Number two, and this is frustratingly for most, cliff edge, and tax never likes being cliff edge. If you're old enough to remember when stamp duty was cliff edge, you used to get a lot of rogue property sellers selling their house for 250 grand because that was the threshold, and then selling the carpets and light fittings and everything else separately for X amount of money. So the buyer pays a significant amount of less stamp duty. So they don't like cliff edge stuff, but this one is cliff edge. And if you, the rules unfortunately are very wishy-washy with this, but it goes down to, if you expect to earn over 100 grand, then you cannot claim two specific childcare benefits. So your 30 hours free childcare for 3 and 4 year olds. I think that's also now 15 hours for 9 months to 3 year olds as well. And tax-free childcare as well, which is like a NSNI account. So if you put 80 quid in, the government will come and put 20 quid in, and you can then go and use that £100 on childcare, so official childcare, nursery costs, or after-school clubs, those kind of things. And if you earn over 100 grand, then you're not allowed to claim it. And speaking to my clients, they reckon that costs them around £10,000 a year per child. So actually, when you're looking at your effective tax rates, going over 100 grand, if you've got a couple of children, actually you could be earning less by earning more, because you lose your personal allowance, you lose your childcare benefits, and you're still paying a decent chunk of tax on there as well.
So as crazy as that might sound to people, you earn £120,000 with two young children. You would actually be better off earning £99,000, because that, I've actually done the calculation with some higher rate taxpayers, and that £20,000 for two kids to be at nursery actually costs closer to £30,000 in a good nursery. And nobody wants to stick their children in a cheap nursery, myself included. So you are better off earning £99,000, substantially better off earning £99,000 than you are earning £125,000.
Yeah, it wouldn't surprise me if when you do the numbers and you've got a decent nursery in there, that's absolutely true. Yeah, correct.
Unbelievable.
Yeah, and it's backwards, right? Everyone wants to inspire and aspire themselves and motivate themselves to be the best person out there, and then you get hammered from a taxation viewpoint. It's pretty tragic. But of course, there is things you can do in order to get your, because it looks at adjusted income. So if your adjusted income is under 100k, there are things you can do that will keep you under 100k. First of all, you can put money into a pension.
Yeah,
pensions have been around for goodness knows how long, and tax relief on pensions has also been around for goodness knows how long, and it hasn't been rumoured that it's going to go anywhere. Well, recently it has. There was rumours that it would change, but it hasn't changed. So you can still put money into a pension. So if you were earning 125 grand and you decided to pay 25 grand into your pension, your adjusted income would be 100 grand. So you can then claim your childcare benefits, and you've also got 25 grand in your pension. So you're going to have a more comfortable retirement.
Okay. Which is a great point to add. It's good that it encourages people, especially in that bracket, to pay more money into their pension, and it will work out for them better in the longer term. But then there's also the other point where once, I believe, child benefits are lost between £60,000 now is the threshold for that.
Yeah. So high income child benefit, there's two things to think about there. So it has recently changed. So certainly this year it will be between £60,000 and £80,000. So this looks at household income. The other 100 grand is also householding, higher earner of the household. So they're similarly kind of rules here that looks at the higher earner. They're talking about changing it to combined income, by the way, but at the moment they're not doing that. So it's the higher earner that you've got to be thinking about here, because of course that's unfair, right? If you've got someone earning 120 grand and the other spouse earning nothing, you've only got 100 grand worth of income. If you've got two spouses earning 99 grand, then you've got 200 grand's worth of income, plus they can still claim their child benefits, which just is naturally unfair. But anyway, high income child benefit charge is between 60 grand and 80 grand. So if the higher earner of that household earns under 60 grand, you can keep all of your child benefit. If the higher earner of the household earns over 80 grand, you have to repay all of your child benefit. And if you earn between 60 and 80, you repay a proportion. So if you earn 70 grand, you repay half of your child benefit.
Okay, great.
Just on that, just to add, they are bringing in a child benefit portal. So at the moment, if you're earning over 60 grand and your household claims child benefit, you have to do a tax return, which is an administrative burden. From next year, there will be a portal that says I'm claiming child benefit, and therefore they will collect it via your PAYE, via your employment, which will appease and simplify the system somewhat, I'm sure.
Okay. One of the things that we come a lot, going back to the salary sacrifice. So essentially, if somebody's earning £120,000, they could sacrifice that £20,000, pay that money into their pension. They could also pay it as a personal contribution at the end of the year as well.
Yeah, absolutely. So as long as it's done in the year. So it's not a question of when you do it. Well, it is a question of when you do it, so long as you do it in the year, but it could be a lump sum. It can be regular contributions. It can be a mixture of both. So it can be either there, and there's other things to sacrifice as well. Pensions is normally the go-to; it's normally the biggest one, but you can, if your employer allows you to. So you need to ask your employer. You can sacrifice your salary for other things, and there's a raft of different things that you can sacrifice your salary for. Company cars is a common one. Electric cars still have decent benefit in kind rates. Petrol or diesel cars don't have so favourable benefit in kind rates. So you need to do the maths there to work out if it actually is beneficial to you, because if you have a petrol or diesel car, actually your tax can go up significantly by you sacrificing your cash for that car. Other things like holiday pay. So a great example is one of my staff members actually said, I don't really want to earn more. She's comfortable on what we're paying her. She didn't want to go up, I think because of I couldn't remember the exact reasons, but child benefit or something like that. So she, instead of taking a pay rise, she decided to sacrifice some of her salary for increased holiday. So now instead of having 5 weeks off, she's actually got 6 weeks off in a year. And that's something that we can accommodate in our particular business, because it's a perk.
Okay, but a perk that isn't taxed, unlike a company car or medical or
basically, because you're looking at the moment, right? If one employee will earn X amount of money working what would be 47 weeks of the year, she will now earn basically the same amount of money, but working 46 weeks of the year.
Yeah.
So from a tax perspective, you don't need to pay any more tax on that. We just need to work it out and make sure that it's appropriate for her, and we can manage that from a capacity angle. So it's an employer issue. It's not an employee issue. She was very grateful that we can actually do that for her.
Very interesting. It's maybe something that business owners could look at and so if. Here's a question for you. Obviously, coming to the end of the tax year, a lot of people run their holidays from in line with the tax years.
Yeah.
And a lot of people come towards the end of the holiday year If somebody hasn't taken all of their holidays, they pay them.
Yeah.
That's taxable.
Yeah.
Great.
And you've got to be very careful there as well, because HR, if you've got the statutory minimum holidays, you're not allowed to pay it. I'm not an HR specialist here, okay? But the reason that we give, that I say we, the collective, the UK, give people 28 days holiday is because that's good for mental well-being and recharging and all of that kind of stuff, right? But if you give more than the statutory minimum, then yes, you can pay your staff that extra if they don't take it because they've worked it, essentially. But that will be taxable on them, just like any other income is. So it could go back into the conversation of, oh, I can't claim my child benefits, or oh, I can't now pay get my free nursery hours because I'm now going over 60 grand, 100 grand, depending on where they particularly are. And it's, it's difficult from an employer perspective. Of course, capacity schedules and all of that kind of stuff, and making sure you've got enough bums on seats and enough hours in the day. If you've got one staff member that's putting in extra hours, great, absolutely nothing wrong with that. But also, if they next year decide to take all their time off, then could be in trouble because you no longer have enough capacity to get the work done. So it can cause some issues from that side.
Okay, great. One other thing I wanted to touch on was a lot of our clients, higher rate taxpayers, and maybe some additional rate taxpayers as well, are, and just to be clear, an additional rate taxpayer is the threshold for that, I believe, is it £125,000?
Yeah, just over, a snip over. So yeah,
so over £125,150.
Yeah,
they pay 45% over and above that.
Correct.
So not only have they lost their personal allowance, that extra £126,000 is getting taxed at 45%. A lot of these clients are being gifted shares. So if somebody is getting shares across, as a bonus every year, let's say they work for a big corporation and they're starting to give them shares. I believe that Nike used to do that at one point, and certain pharmaceutical companies and stuff like that. How are these shares taxed? Let's make that clear to people.
Okay. So you've got to be careful of vesting dates, and you've got to look at this the scheme that your employer is offering, because there can be some quirks here. But broadly, that additional shares should be taxed as income. So it should go on your pay slip. The market value of the shares goes on your pay slip, and then you can pay tax on that accordingly.
So the market value goes on your pay slip?
Yes.
Even if they're being given to you at a discounted rate?
I think the tax position needs to be the market value, but you don't need to necessarily pay the market value for them.
Okay.
And then you need to look at the vesting date, because I can't remember the exact terminology with them, but there's two different main types of shares here, because you could be awarded them but not allowed to sell them for a certain amount of years, which is normally very common because it inspires longevity in that particular employment. And then, of course, when you sell them, you can pay tax on the gain at that point in time as well. And if you've not paid your tax originally on the market date, then I think that will then affect the tax you pay when you come to sell them, and that's the issue you've got there. And in most cases, it works out when you look at, so long you expect the company to do well and grow and share price go up. When you look at the play on taxes, most people will take to pay the tax now in employment now when you're gifted them, to then pay lower tax when you come to sell them.
Right. Okay. So there's also the additional rate taxpayers lose the ability, and you'll tell me the technical term for this, but they lose the ability to be able to contribute the maximum amount, the £60,000 into a pension, and their pension contributions are then tapered.
So it's not just additional rate taxpayers. So you need to be earning on paper over 200 grand to get a taper for your annual allowance. So additional rate kicks in at 125. But if your threshold, so there's two incomes here with tapering of pensions: your threshold income and your adjusted income. And if your threshold income, which broadly, don't quote me on this and speak to your own advisors, but broadly threshold income is taxable income. So what goes on your tax return. If that's over 200 grand, then you need to look at your adjusted income. If your adjusted income is over 250 from memory, then you have a tapered to that annual allowance. So normal pension allowance is 60 grand. That's reasonably generous. It used to be 40 grand a couple of years ago, which means that you can put 60 grand a year into your pension and get tax relief on it. If you go over that, then you pay tax on the excess. Okay, and that's the point here. So it almost becomes nonsensical to put more than 60 grand a year into a pension. You can do a bit of work with carry forward and unused allowances and stuff like that. But if you're a higher earner earning over 200 grand, then yeah, your annual allowance could be tapered. It can get tapered all the way down to 10 grand. So if you're earning 360, something like that, over 360 grand a year, then you'll probably only have a £10,000 pension allowance, which just means you can't put a lot into a pension, right? And if you put 10 grand a year into a pension for 30 years, I appreciate if you're earning 360 grand a year, you're probably doing all right anyway, but your pension isn't going to be sizable because of the limits that you've got there, which naturally lends yourself to looking at the other opportunities out there. So making sure you're utilising your ISAs. Rachel Reeves rumoured to attack cash ISAs at the next budget, may not attack stocks and shares ISAs. The Tories were going to bring in a British ISA before they got kicked out of power. Wouldn't surprise me if some kind of British stocks and shares ISA was coined, because it would then force people that want to invest in ISAs to invest via stocks and shares in British companies. Naturally, that could well boost the economy, which is, number one aim of the Labour government. So yeah, look at your ISAs and then look at your other weird and wonderful investments, which tend to be for more high net worth. So your EIS, your enterprise investment schemes, SEIS, which both of them are really young companies, really risky companies, but they do come with some tax breaks. And then your VCTs, your venture capital trust as well, which again is a risky investment, but again does come with some tax breaks.
So, I mean, it'd be interesting to see how many people have a tapered annual allowance, and how much money would go into the UK markets if they could pay the 60 grand a year every year into their UK pensions, instead of additionally paying tax to HMRC. Because while I think the encouraging people to put money or take salary sacrifices once they get to £100,000 and above, it's almost like sacrificing people. And I think during COVID, there was a problem with doctors with the NHS who were working extra hours, who were being penalised and not being able to put money into their pensions. And while I get it for a lot of the general public, it's like, well, that's a nice problem to have. It's not really, because they're going to work less hours and be able to produce less of a service. And now we're seeing more and more of them moving overseas for jobs that are paying them tax-free income, working at fantastic healthcare trusts and stuff like that. So we're kind of pushing them away from this country.
Yeah, we are. And look, I act for a fair few young doctors actually, and new consultants that are walking into their consultancy position now, which I think the base salary is 95, 96 maybe. Once they're a year or two post CCT, post consultancy, they'll be on 110, 115. A lot of them are going, well, I don't want to work full time. I've got young children. They're in nursery. If I actually work 80%, 60% and get myself to 100 grand, fine. I'll enjoy life more. I'll spend more time with the family. I won't do those extra lists. And that is just counterintuitive to a country that has waiting lists of God knows how long. I haven't looked for a while, but big backlogs in hospitals and people that don't want to work because they're going to get penalised so much from annual pension tax charges and general income tax.
Mm. And again, I've worked for doctors, a lot of doctors that have worked overseas in the past, and some of them earn in excess of £50,000 a month. And I have never come across anybody that begrudges a doctor earning a lot of money.
No, absolutely.
And yet,
look,
yeah.
If I get something wrong, someone over or underpays some tax, we can correct it, we can fix it. God forbid that I do. If a doctor gets something wrong, lives are on the line. They deserve to be well remunerated. They've gone through school and education and university with big university debts, and they have a massive responsibility on their shoulders to make sure that they don't make an error.
Yeah, no, it's one that we could. We're getting close to having a big rant on when we're supposed to be providing people with information.
But obviously, what you can't do is just give doctors a unique, a specific, an extraordinary tax rate, right? Because that's unfair. That will go to court. That won't be fair on the population, and therefore they need to make sure it is fair for all. So how they monitor that or control it or deal with it, just don't know. But that was one of the reasons that the annual allowance went up, for argument's sake. And they've also brought in, they had this McLeod judgment and various other things going on, where the NHS are being a bit more kinder to them, I think, from tax charges and stuff like that.
Yeah, well, let's watch this space. I mean, we could look at a lot of additional rate taxpayers or higher earners earning 300, 400, 500 millions of pounds a year and begrudge them for doing it. But actually, the amount of money that they put back into the coffers for HMRC is, in some cases for my clients, 10 times the amount that the everyday earner is.
Yeah. And the last thing you want to do is move the really wealthy outside of England, which unfortunately I think they are. I think the UK's wealthiest man left this week. I read somewhere. I don't know who it was, but apparently he's left the UK. He'll no longer be contributing to the UK tax system, and will be down a decent chunk of money, I'm sure.
Yeah. Yeah, we actually ran something on this, and I think the number of millionaires leaving the country, leaving the UK, is one every hour, something ridiculous like that. A millionaire leaving this country, one every hour, and that has a massive, massive effect on the amount of money that HMRC actually receives, which will have a knock-on effect. What do they do about the less amount of tax being paid? Well, they're probably going to tax people more.
There's three ways to get it, right? They can inspire growth and grow the economy. I mean, that's number one, because that's win-win-win for all, right? Okay, maybe not those outside the UK, but if the economy's bigger, people make more money, people pay more tax. So that's always number one. Number two is to raise tax, which is never a vote winner. Let's face it. I think everyone in the UK is feeling the squeeze right now with increased taxes and cost of living crisis and all of those things. And then the one they kind of looked at more at the spring statement is to reduce spending. So reduce the amount of money that's going into welfare, reduce the amount of money that's going into certain benefits and spending.
Yeah. Okay. Let's change the subject slightly. So, housing and property market, which can be quite brief and quick. The government is pledging to build 1.3 million new homes over the next 5 years, supported by planning reforms. What impact is that expected to have on the housing market? I'm sure they want the housing market to thrive, but what is the effect of, straight away, there are some changes on the stamp duty taxes this year, aren't there?
Yeah, so I'm not sure if it was 1st of April or 5th of April it comes in, but it's pretty much now. You used to be able to get a house of under £250,000 and pay no stamp duty. There's still an exemption for first-time buyers. Okay, so if you are buying your first property, you can buy a property for £300,000. Was 425, it's been reduced to 300,000 and not pay any stamp duty. But if it's not your first home, you will be paying an extra £2,500 in stamp duty if your property is valued over £250,000. Which, give with one and take with the other. Flood the market with loads of new houses, great, absolutely. That's going to inspire new first-time buyers, and it's going to inspire people to move houses. But then if you tax them more when they buy and sell houses, then that's a bit of a barrier of entry for people to actually move. And we all know moving is an expensive thing. Once you put on the fact that you've got to pay an extra £2,500 stamp duty, and then if you're buying multiple properties, you've got to pay an extra 5% stamp duty because you're owning additional properties. It's an expensive transaction to do now, is to buy properties.
And you've also got more and more landlords seem to be selling their properties because of the certain changes on taxes. So landlords are selling them. And am I right in thinking that holiday homes are now being taxed differently as well?
Yeah. So that's kicks in again beginning of this tax year. So right about now, holiday homes or furnished holiday homes, they need to meet some very specific criteria, which I won't remember, but broadly they're a holiday home. Okay, so someone can go there, have a holiday there. It's all kitted out and ready for a holiday. So, beds and chairs and saunas and jacuzzis and whatever you want from a holiday home, board games, TVs, etc. And it needs to be on the market, available to let for a specific amount of time every single year. It used to be treated more as a commercial property, which comes with tax benefits. So this section 24 has been around it got phased in from 2016 to 2021, where if you're an individual landlord, you no longer deduct mortgage interest from your rental profits, and instead you get a 20% tax bracket. And that, if you owned 10 properties, that, I can give you an example of one of my clients. He owned a lot of properties. He had high mortgages on the properties. Because the mortgage interest was high, he historically didn't have to pay much tax. The reason that it suited him is because of the capital appreciation of these properties. So over time, he will have a more expensive property because property values have continued to increase. Once this rate change came in, for him, I think he had about £50,000 employment. His tax went from almost nothing to potentially 30 grand a year because of these changes. So it really, really can affect those with multiple properties. So that's been around for a while. Furnished holiday lets will now go into that. So they will have this section 24 thing. So naturally, if you've got a mortgage on a furnished holiday let and you're a higher rate taxpayer, your tax is going to go up. The ability to deduct the fit out costs for your furnished holiday lets will be gone as well. So you can't claim capital allowances on any of the costs to fit it out. Definitely anyone with furnished holiday lets just needs to review their position and see what the tax position is going to be going forward, because it will be different.
And also, like you said before, the stamp duty changing ever so slightly, going up for your everyday moving house, which in my opinion is going to affect growth as well, because the amount of people, when you build a load of houses, how many people do you give work to? When you move house, how much money do people want to spend on furnishing that house and getting a gardener in, getting the garden, like everything that's involved in house moves, really, by discouraging it. And I just had again, we talk about resenting people that earn more money and buy bigger houses. I just had a client pay in excess of £150,000 stamp duty on moving house. Again, huge contributions. Not only do they pay millions of pounds a year in tax, they also pay, it's an extra couple of £100,000 in stamp duty. So these people are making huge contributions to the coffers.
Yeah, I know, and it's crazy. And the UK tends to be one of the only countries that really bemoans success. You look at the Americans for an example. They would be cheering from the rooftops if one of their buddies just paid 150 grand in stamp duty buying their dream home. The UK, we all seem to resent it and put people down for their genuine successes, which is probably a bit backwards as a nation.
Again, we could rant about that all day long, and we do really need to cheer success a little bit more. I just want to go from what we were talking about before to employers, the changes for employers, because obviously as an employer, I've noticed, and I was so excited about moving back to the UK and setting up a business and employing people in my local town and giving a service back to the country where I was born, etc., etc. And more since I've come here, the changes that have been made since 2018, 2019, corporation tax has gone up.
Yeah.
I think it was at 19% when I first came back.
It would have been, yeah, and it would probably, when you came back, it would probably be the time when Boris Johnson was in power and was rumoured to drop it to 17% at one point in time, which never came in, or it came in for a very short amount of time. I don't think it came in the end. So yeah, it was 19% back then.
Yeah, it's now, I believe, 25%, pretty much there or thereabouts, if you make a significant profit.
Yeah, 25%. If you have one company and your profits are under 250 grand a year, then less than 25% minimum, it will be at 19% for really, really small businesses. But it's very, very rare. Do you have a limited company with profits of under 50 grand without them having, the owners having other limited companies? They might have a residential property company and a trading company. But anyway, yeah. So it's between 19 and 25%, but the majority of people, I imagine, will be paying 22% plus, depending on their profits.
Yeah. So you pay more for profit.
Yeah.
This year, again, national insurance contributions are going up, employers' national insurance contributions.
Yeah, and it's a horrible one as well, especially for big employers, because it's really, really going to hurt people that want to employ more people. And it may push people overseas because it's cheaper to employ people overseas, or to outsource specific functions overseas, perhaps. So, there's a massive, I don't know if we'll come on to that later, but there's a massive issue in the UK. Something like 20% of the working population are not working. Which, if they were all working, then the tax that they would then be paying, rather than claiming welfare benefits, etc. I appreciate some of these are going to be disabled, etc., etc. Yeah, not all of them are going to be able to work. Don't get me wrong, but those that can work, if they were, actually the outlook may be a bit more promising. But anyway, to get to the point, national insurance. So employers' national insurance has been around since as long as I can remember, and it's a tax to employ people. Okay, so your employer pays it. And historically, it was 13.8%, and it was only for an employee that earned more than £9,100 a year. And they've done two things, which kicks off in the year ahead. They've reduced the threshold to £5,000, so a lot more staff will now be paying, or the employer will be paying more tax on a lot more staff members, especially those part-time staff members that weren't working full-time, maybe a couple of days a week. They will now be paying to employ them. And the rate has gone up from 13.8% to 15%. So those two things, except for really small employers, so those maybe with 4, 5, 6 employees, actually for those, that the impact might not be too vast, because there's a kind of relief available called the employer's allowance, which if you qualify, most businesses in the UK would qualify. If you qualify, you get to knock off historically £5,000 against your employer's national insurance bill. From the year ahead will be £10,500. So that increase in that relief will mean that small employers actually don't necessarily pay more, but for anyone with more than 5 employees, it's likely they'll be paying more employers' national insurance, which is just another nail in the coffin when it comes to growth. Because yes, Labour committed and delivered on their promise that they're not going to increase taxes for workers, but by taxing employers for employing workers, it stagnates pay increases. So where you may have got a 4% pay increase last year without these national insurance changes, you may only get 3% this year. So indirectly, it has affected employees, because it's squeezing the profits of employers. And trust me, if employers can pass it on, then they probably will. Yeah.
And so they've increased the employers' national insurance contributions, and they've increased the corporation tax. They've also increased, and again, this is quite relevant for, let's say you've got a restaurant, and I'm seeing more and more of these going under, successful ones in the past, very good restaurants.
Yeah.
They have 15 waiters that they employ. They've been very successful. Their corporation tax historically was 19%. They were paying 13.8% national insurance contributions. All of these, let's say, part-time workers, university students or whatever were on minimum wage. What's happened with minimum wage this year?
Yeah, so it's gone up. I've got the figures in front of me. So it was £11.44 last year. In the year ahead, it's going to be £12.21. That is an increase of 77p, but more importantly, an increase of 6.7%. Okay, so in terms of pay increases, a huge pay increase. And you're looking at especially the likes of hospitality, right, where they do employ a lot of young people, a lot of part-time workers, a lot of people in education. That's crippling. What would the population do if all of a sudden 6.7% was added onto a price of a pint? I think there'll be uproar, there'll be riots. So, it's going to be very difficult for those increased costs to be passed on. And of course, it's not 6.7%. Once you add on increased national insurance, add on corporation tax, which went up a couple of years ago, there will be more and more people that just can't make these businesses work. And it will be another potential nail in the coffin for some hospitality businesses, and some doors might have to shut or prices have to go up. And increasing prices in hospitality will naturally mean more people will stay at home and they won't go out. So can they do it?
So it sounds like when people use these vote winners, or I call them, we're going to decrease the cost of a pint by 10 pence.
Yeah.
Well, it's utter nonsense, really, isn't it? Because they might decrease the cost to the pub by 10%, but why would they pass it on if corporation tax, national insurance, minimum wage, all of these things are going up as well?
Yeah. Well, exactly. Yeah. And, there's, I won't get the saying exactly correct, but there's a good theory in if you reduce taxes, actually you get more income. Yeah. So by the government reducing taxes, one, there'll be less people trying to do shady things because they can't afford to live. And if they can't afford to live, more people are wanting to do dodgy stuff.
Yeah.
Two, it inspires growth because then all of a sudden people have more confidence in the market. If I know that I can go and employ 3 more people in the year ahead without being crippled from a tax viewpoint, then I can go and better my business and improve my business and therefore pay more tax because I am making more money.
And I think the government also announced it plans to intensify its efforts against tax avoidance to generate an additional £1 billion in revenue.
Yeah, and this is called the tax gap. And the tax gap is essentially the amount of money the government expects to get versus the amount of money they actually get. Okay, and the difference between the two is called the tax gap. It's £40 billion they expect that tax gap to be. And I think by introducing the measures they're introducing now, they expect to raise income by £6.5 billion a year come 2030. How they're doing that? Well, they're going to use AI. So the government and HMRC are definitely getting on board with AI. I think you'll find this more and more of a theme. They're talking about e-invoicing, which is certainly something to consider and discuss. Making tax digital is coming in. So there's this theme of using AI and digital accounts and stuff like that, which will hopefully close the tax gap. But also, frustratingly, for a lot of smaller businesses, so SMEs, and when I'm talking small, I'm not talking actually small, under 50 million quid of revenue or something like that a year, or certainly under 10 million quid of revenue a year. So they're still big businesses, right? They're just defined as small. They will be targeting on them, and they're going to employ 5,000 more HMRC inspectors over the next few years. And they will be looking at SMEs, owner managed businesses. And the reason they'll be doing that is because of that £40 billion. It's estimated 60% is due to SMEs. So there's a graph that I can happily share where 60% is small businesses, 9% is criminals, 10% is large businesses, 10% is medium businesses, and then 10% is individuals or wealthy individuals. So low hanging fruit, right? If you can target your efforts on SMEs, which are contributing to 60% of the tax gap, naturally that's what they're going to do. Plus using AI to try and help and target their efforts to more specific areas.
Wow. So they're going to employ 5,000 more people.
Yeah. I also think they're having a bit of a review on their civil servants, because I think the employers, they employed something like 150,000 more people over COVID and they haven't got rid of them. So I think there might be a little bit of a reshuffle or something like that going on. Don't really know. That's my own theory. But yeah, they're going to do more investigations. I think that's inevitable. I think with the last 5 years of the Tory leadership, as an accountant, I'm probably pretty happy to say that HMRC inquiries were at a low level. There wasn't too many checks going on, because we live in a submit now, check later tax world. So you submit now and HMRC reserve the right to check. And if it's wrong, they will penalise you. If it's right, of course, they won't. Labour, I think, will shake this up quite considerably, and there will be a lot more investigations going on. So if you're running your own business and your accountant offers you tax investigation subscription, it's probably a good time to consider taking it, because that's like an insurance against an HMRC inquiry. So a normal full inquiry will cost a few £1,000s in costs in accountancy time, sitting down with HMRC and going through the file and explaining the weird and wonderful things that are your accounts and tax returns. If you've got that service, then you don't have to pay your accountant anything, and all you'll need to do is pay HMRC any tax if you've done anything dodgy, if there's anything they don't agree with in there.
Can you think of any commonly overlooked tax allowances that people don't take advantage of? And I mean, I think not enough people take advantage of, whether it's salary sacrifice or personal contributions to pensions. I see all these people wanting to save money, but the amount of money, and we do this every year with our annual suitability reviews, we look at the amount of money somebody is saving, but also look at the amount of tax that they're paying. And while for younger professionals, they often think of saving money and put it into a pension, it's sitting there for the next 20 years and they can't touch it. But there are a lot of tax benefits for your monthly savings going into a pension.
Absolutely. And I think it's pretty criminal for those that aren't thinking of pensions still, because it's almost free money. Okay, don't get me wrong, a pension is like a tax deferral, but if you're paying, God forbid, that 60% bracket now because you're earning 125 grand, by putting some money into a pension, you'll be saving 60% tax, right? And therefore, by putting some money into a pension, you're saving so much in tax that actually it almost becomes a no-brainer, especially if you couple that with your childcare benefits and stuff like that. It's really disappointing to see clients come to me and say, oh yeah, this is my situation, I haven't put anything into a pension forever, what should I be doing? And just sitting down with them for an hour and going, right, look, if you do X, Y, or Z, then you can be a bit more tax efficient. But there's some small benefits. So you've got your interest savings allowance, which is £500 if you're a higher rate taxpayer, and £1,000 if you're a basic rate taxpayer. You've got the trading allowance, which is a little known relief, which means if you're an employee but you do some used to be like the Avon lady, right? But let's look at more new school things, people selling on Etsy, or people doing some kind of hobby that generates a little bit of income. Actually, you can get £1,000 worth of tax-free income by doing that particular thing, because you've got a trading allowance which allows you to not need to report or pay anything.
Travel agents, loads of people seem to go into travel agencies. Some people do not dodgy, I shouldn't call it dodgy, but like perfume sales and stuff like that, so they can get up to £1,000 of that as tax-free income.
Yeah, exactly. If it's over £1,000, it needs to be reported and tax needs to be paid. But if it's under £1,000 a year, then it's free.
Great.
Rent a room allowance. So if you're living in London or another major city and you rent a room out of your house, and you can get £7,500 a year tax-free by renting a room out in the house that you live in. So that's a very nice relief.
Is Durham classed as a major city?
Well, it doesn't need to be. Sorry. So to confirm, I said major city because major cities tend to need more people living house sharing.
Yeah.
So it can be anywhere in the country. Okay. It's just might be very difficult to find someone to rent your room in some unscrupulous places of the world. But if if you found someone in Durham that wanted to come and rent a room in your home, absolutely, they can pay you $7,500 a year, and you don't pay tax on that.
Can once a child gets over the age of 18, can I do that?
I don't know. I need to look at it. You've got a few years to go, Hamzah, I think. So you could ask your wife to pay you $7,500 a year, couldn't you? That would be nice.
Right. Okay. I'll let you ask her for me. And just one last thing. The spring statement didn't introduce immediate tax hikes. The impact of frozen thresholds and policy changes will be felt over time.
Yes.
What can we do to take action now on those kind of things?
To reiterate the things we've talked about, look at your reliefs you've got, right? Because, I mean, first of all, if you need the cash in your back pocket, then there's no magic wand. Okay? If you're living hand to mouth, then it's a very difficult situation to be in right now. But if you do have the ability, if you do have some spare cash, then making sure you're making that cash work for you. So think of pensions, think of ISAs, think of sacrificing your salary for a company car or cycle to work scheme, or potentially buying more holiday off your employer. If you are running your own business, make sure you've structured it correctly. So are you a limited company? Are you utilising all the reliefs available to limited company? If you're not, should you be? Again, it's not black and white. It needs a discussion. And just don't bury your head in the sand. I mean, that's the main thing, right? Speak to the people. If you don't understand it, speak to the people that do understand it. Pick up the phone, surround yourself by people that can help you, because if you don't speak to anyone, then you're not going to be able to know if you're missing out on something.
Yeah, absolutely. Speak to an accountant. Good little plug there for Humphrey and Co at the end.
Thank you. Appreciate it.
All right, Michael, I think I've taken up more than enough of your time. I'm very grateful. I'd love to do another one of these again in the future, hopefully discussing tax reductions, but you never know. Fingers crossed. And don't forget, let's celebrate people that are successful.
Yes, it's a good takeaway.